If I had to explain why Wall Street may be about to rethink SoFi stock from scratch, knowing what I know about what just launched, how this company is quietly changing its revenue mix, and what usually forces analysts to change the way they value a business, I would do it very differently. Most people think a stock gets repriced because of one hot headline or one flashy quarter, but that's not usually how it works. What changes the story is when the market realizes a company it thought was one thing is becoming something else. And that is why this SoFi setup matters more than a lot of people seem to understand. Now, today is Wednesday, April 15th in New York, so comment below with the day and date you're watching from. And real quick, we do offer members-only videos made by a separate team with deeper research, so if you want that kind of extra work, support the channel by subscribing. Because what just happened here is not really about a button inside an app. It's not just, oh look, transfers are faster now, that's cute, moving on. No, this is about the market maybe starting to see SoFi less like a plain old lender and more like a layered financial platform with more fee income, more infrastructure value, and a lot more operating leverage than the old bear case wants to admit. The headline event is simple enough. Through Galileo, SoFi now lets members send and receive money through the FedNow rail in real time, all day, every day, including weekends and holidays. And that sounds small until you remember how money usually moves in banking. Usually it crawls. Usually you wait. Usually the interface says pending, and then your money takes its sweet little Sunday drive before it shows up. This changes that. Now here's where people miss the plot. Convenience is nice. Speed is nice. Customers absolutely care about that. But Wall Street does not hand out higher multiples because your app feels smoother on a Saturday afternoon. Wall Street reprices when smoother turns into monetizable, repeatable, scalable behavior. That's the bridge. And this new instant transfer feature looks a lot more like a bridge than a gimmick. Based on recently published company materials, SoFi can now move money in seconds between a SoFi account and eligible outside bank accounts, while Galileo provides the infrastructure underneath. The very important detail is that most institutions on this network still lean receive only, while SoFi is pushing both directions. That matters because sending is where the user habit gets stickier, the utility gets more visible, and the revenue opportunity gets more interesting. And yes, there is a fee angle here. Outgoing instant transfers are not free, and premium users get a discount. I'm not going to get lost in spreadsheet theater over every penny, but the structure is clear enough. SoFi now has another little toll booth. Maybe not a giant one on day one. Maybe not some magical money cannon overnight, but a toll booth all the same. When users value speed, even modest pricing can become meaningful at scale. That's especially true in a business that already has a very large and still growing member base. From recent company filings, SoFi closed last year with roughly 14 million members after adding a little over 1 million in the fourth quarter alone. Product growth was even faster. Deposits climbed too. Spending activity climbed too. And when you combine more members, more accounts, more money on platform, and more reasons to keep money there, transaction intensity tends to follow. This is where the story gets spicy. The market has spent years arguing about SoFi as if the entire company lives and dies by personal loans. That's the old lens. And to be fair, lending still matters a lot. It throws off a huge amount of revenue. It drives earnings. It carries real credit sensitivity. So I'm not here to pretend SoFi woke up and suddenly became a pure software company in a tailored suit. That would be silly, but it also doesn't mean the mix isn't changing. According to the latest quarterly results, total fee-based revenue jumped by a bit over half from a year earlier and reached a record level, while the financial services and technology platform segments together grew much faster than lending. Financial services revenue was up sharply. Technology platform revenue still moved higher, and total fee-based revenue was running at something close to a nearly $2 billion annualized pace. That is not a side hustle anymore. That is starting to look like a valuation argument. And that's before you layer in what management has been launching outside this one transfer feature. Over the past stretch, the company rolled out consumer crypto trading again, introduced its own fully reserved stablecoin infrastructure, expanded private market access inside Invest, added basic options capabilities, pushed further into fee-generating loan platform deals, and then just recently launched a business banking offering aimed at firms that need to move fiat and digital assets around the clock. That is not random product clutter. That looks like deliberate ecosystem building. Now, I want to slow down here because this is the part people either understand immediately or completely whiff on. A lender is often valued on credit quality, funding costs, charge-offs, capital, and how cyclical its book might be. A platform business with fee streams gets looked at differently, not infinitely differently, not magically differently, but differently enough that the stock can wear a higher multiple when the market believes the newer revenue is durable, recurring, and less balance sheet hungry. That's the real reason this FedNow move matters. It's not because one transfer feature alone changes the world, it's because it fits a pattern. And markets don't usually reprice off isolated products. They reprice off patterns. One new feature, okay? Two, maybe. But when you keep stacking fee-based services, infrastructure tools, and higher engagement banking behavior on top of a growing member base, eventually the spreadsheet nerds on the street start rebuilding the model, whether they want to or not. There may also be a second layer here that is even more interesting than the consumer fee. Galileo already powers infrastructure for banks and fintechs. Company and Federal Reserve materials indicate the foundation is in place to extend these instant payment capabilities to outside partners through SoFi Bank. That means SoFi is not only trying to be the place where a member taps a button, it may also be one of the pipes underneath other financial apps. And the market often pays more for pipes than people expect because pipes scale. Now, let me add a dose of skepticism, because blind optimism makes people poor. There is a bull case here, yes. But there is also a trap people fall into with stories like this. They take a genuine positive development and immediately start annualizing it into fantasy. You know how it goes. New feature on Monday, trillion-dollar opportunity by Thursday, private island by Friday. Calm down. Instant transfer fees can be attractive, but they are not guaranteed to explode just because peers have done well with similar behavior. Adoption still matters. User behavior still matters. Network reach still matters. Execution still matters. And on top of that, SoFi is still dealing with critics who say the company's lending economics and accounting deserve more scrutiny. We saw that tension flare up recently when a short seller challenged the company's reporting. And SoFi forcefully rejected those claims and said it was considering legal action. So the market is not in some blissful honeymoon here. There is active debate, which means management still has to prove the cleaner, fee-heavier story with numbers, not speeches. But here's the thing. Debate can actually set up repricing when the evidence keeps moving one direction. If investors are worried the company is just dressing up a lender, and then quarter after quarter the fee streams deepen, the product set broadens, the member base rises, and more financial activity stays inside the ecosystem, the burden shifts. Suddenly the question is no longer, is this just a lender? It becomes, how much of this business is now being misclassified by the market? From recent official results, management is guiding for around 30% revenue growth this year, with member growth expected in that same neighborhood and earnings also moving higher. Those are not sleepy numbers. Those are the kinds of numbers that get attention when a business is already profitable and when its non-lending businesses are growing faster than the legacy perception. If that guidance gets supported by additional proof that more revenue is coming from payments, subscriptions, interchange, referrals, infrastructure, and platform services, the valuation conversation changes. And that is where I think Wall Street may be late. Not forever. Wall Street is rarely wrong forever. But it is often late in admitting category shifts. It likes neat boxes: bank, fintech, lender, platform, software, payments. It wants to slap on the label and move on to lunch. So when a company starts stepping across those boxes, the stock can stay messy for a while. Then one day the market wakes up and says, hang on, we may have been using the wrong box. If you're successful, share your success story in the comments so others can stay motivated. Because this is bigger than one ticker. This is how repricing often works in the real world. Not with fireworks, but with accumulating evidence. A little here, a little there, then suddenly what looked like noise becomes a pattern, and what looked like a lender starts getting treated like a broader financial operating system. I'm not saying SoFi is fully there yet. I am saying the ingredients are lining up in a way that makes the old valuation framework look less comfortable by the month. And don't ignore timing here. The company is not making these moves while shrinking into irrelevance. It's doing this after reporting record revenue, record members, record products, stronger fee-based contribution, and continued product launches across both consumer and enterprise angles. It's also doing it in a market that has become much more sensitive to quality of revenue. Investors are not just asking, are you growing? They are asking, what kind of growth is it? How capital intensive is it? And does it get stronger as the ecosystem gets denser? That last part is key. Dense ecosystems are hard to price when they are still being assembled, but once they begin reinforcing themselves, things can move quickly. Faster transfers help keep money inside the app. More money inside the app can support more spending, saving, investing, and cross-sell. More activity improves monetization. More monetization supports margins. Better margins and a less loan-heavy mix support a better multiple. And that better multiple is how a stock gets repriced, even before every last dollar shows up in reported earnings. So no, I don't think this is just another shiny fintech announcement that people clap for and forget by next week. I think it is one more piece of a broader migration. A migration from being judged mostly on lending spread and credit risk, toward being judged more on network value, product depth, member engagement, and fee durability. That does not erase the risks. It does not end the debate. But it does make the story richer than the lazy version many people are still trading on. So keep your eye on the next few quarters. Watch whether these instant transfers actually gain traction. Watch whether the financial services and technology lines continue to outgrow lending. Watch whether management keeps stacking products that deepen the ecosystem without stuffing the balance sheet with unnecessary risk. And watch whether analysts begin talking less about SoFi as a loan machine and more about it as financial infrastructure with a consumer front end. If that language changes, the multiple can change. And that, in my view, is why Wall Street may be about to reprice SoFi stock. Not because of hype, not because of one press release, but because the market may finally be forced to recognize that this company has been building more than a digital lender, and every new fee-based layer makes that harder to ignore. Now, another reason I think people may be underestimating this is because fast money behavior already has a proven willingness to pay dynamic across finance. Consumers and small businesses repeatedly show they will pay for certainty, not just speed. It's not merely about impatience. It's about avoiding overdrafts, catching a bill on time, covering payroll, grabbing an opportunity, or just making sure the left hand and right hand of your finances are not arguing with each other over settlement windows. When money movement becomes operationally important, even small fees can become normalized. And SoFi has another lever there through its premium membership. The discount on instant transfer pricing is not only a price cut, it is a nudge. It gives people one more reason to stay inside the paid tier, use more services, and think of the app as their primary financial home base instead of a side account. Subscription economics by themselves are nice. Subscription economics attached to broader banking behavior are nicer. That is how average revenue per user tends to mature over time. There's also a historical angle worth remembering. Financial names often get re-rated when investors stop seeing them as pure balance sheet stories. You saw versions of that with exchanges, card networks, and payments processors over the years. The market loves businesses that can touch more transactions without having to warehouse every ounce of risk themselves. I'm not saying SoFi becomes one of those overnight. I am saying the closer it inches toward that hybrid model, the more pressure there is on the old valuation shorthand. From recent market pricing, the stock is still sitting in the high teens, which tells you this is not some universally loved, fully priced dream story already. There is still skepticism in the tape. There is still hesitation in the analyst community. And honestly, that's part of why the setup is interesting. Repricing opportunities usually do not begin when everyone agrees. They begin when the evidence improves while the narrative is still catching up. And one more thing, the business banking launch from earlier this month matters here more than people think. When you combine 24/7 money movement, stablecoin settlement capabilities, direct bank infrastructure, and Galileo's distribution, you start to see the outline of a company trying to sit at multiple layers of the stack at once. Consumer app on top, regulated bank in the middle, infrastructure rail underneath. That is a much more powerful picture than just saying they make personal loans on a phone, and that matters immensely. As always, this is for education and discussion, not a blueprint for your money. Do your own homework, pressure test the bullish case, respect the risks, and make decisions you can still live with when the market stops being polite.